Welcome to the Self-Tax YouTube channel. If you're an expat, business owner, or landlord and you're not subscribed yet, this channel is for you. We break down tax rules, deadlines, and changes, clearly and simply. Hit subscribe and stay compliant, without the stress. Meet Adam. He runs a small limited company in the UK. Like many directors, Adam pays himself in what used to be the most tax-efficient way. A small salary through pay, and the rest as dividends. For years, that approach worked well. But as we move into 2026, something has changed. Dividend tax rules have been tightened more than almost any other part of the UK tax system. Allowances have been slashed. Income thresholds are frozen. And HMRC is paying closer attention to dividend income than ever before. The result? Many business owners are now paying more tax, even though their income hasn't increased. In this video, we'll explain exactly what's changed, why so many directors are being caught out, and what you need to know to stay compliant and prepared in the new dividend tax landscape. Let's break down the facts, so you clearly understand what's changed. First, the dividend allowance. In 2022, it was £2,000. In 2023, it was cut to £1,000. In 2024, it fell again to just £500. And as we move into 2026, it is still only £500. That is the lowest dividend allowance in UK tax history. What does that mean in practice? It means almost every limited company director who pays themselves using dividends will now pay more tax. Now let's look at the dividend tax rates. The basic rate remains 8.75%. The higher rate is 33.75%. And the additional rate is 39.35%. The rates themselves have not increased. But because income thresholds are frozen, and inflation has pushed earnings higher, more people are being dragged into higher tax bands, even when their income stays the same. Let's go back to Adam. Like thousands of small business owners across the UK, Adam runs his company and earns around £60,000 a year. To stay tax efficient, he pays himself in the way many directors do. A small salary through pay, and the rest taken as dividends. For years, that approach worked exactly as expected. But when Adam reviewed his tax projection going into 2026, he got a surprise. His tax bill had gone up, even though his income hadn't changed. So what happened? The answer is simple. The dividend allowance is almost gone. With only £500 now tax-free, far more of Adam's income is being taxed than before. And Adam is not alone. HMRC estimates that millions of people across the UK are being pulled into dividend tax for the first time, not because they are earning more, but because the allowance they relied on has quietly disappeared. There are three groups who will feel the impact of the dividend tax changes the most. First, limited company directors. If you pay yourself using dividends, your tax bill now increases automatically once you go over just £500. Second, small investors. Even modest share portfolios can now generate taxable dividends, where previously they did not. And third, business owners with growing revenue. If your salary stays the same, but your dividends increase, you will move into the higher dividend tax band much faster, because income thresholds are frozen. Adam falls into the first group. He took the same dividend in 2025 and again in 2026, but his tax bill still went up, simply because the tax-free allowance had almost disappeared. HMRC has made it clear that dividend income is one of the most underreported types of income in the UK. And now that the dividend allowance is extremely small, HMRC is widening its net to catch mistakes and underreporting. This is how they do it. They cross-check bank deposits. They receive data directly from UK investment platforms. They match company records against directors' self-assessment returns. And they use digital systems to identify gaps automatically. HMRC can also request annual summaries from platforms such as Trading 212, Free Trade, and Hargreaves Lansdowne. The days of quietly taking dividends without reporting them are over. Here is a simple breakdown of how dividend tax is calculated in 2026. Step 1. Start with your total dividend income for the tax year. Step 2. Subtract the dividend allowance, which is now just £500. Step 3. Add your dividend income to your salary and any other taxable income. This determines which tax band you fall into. Step 4. Apply the correct dividend tax rate. 8.75% at the basic rate, 33.75% at the higher rate, and 39.35% at the additional rate. Because the £50,270 threshold is frozen, more people are slipping into the higher rate band, even when their income hasn't increased. These are the most common mistakes that now lead to penalties. First, not declaring dividends taken from your own limited company. HMRC can see this. Second, assuming dividends under £1,000 are tax-free. They are not. Only the first £500 is tax-free. Third, taking dividends when the company does not have enough profit. That is illegal under company law. And fourth, continuing with old tax strategies without adjusting for the new allowance levels. Adam realized his accountant had been repeating the same plan every year, while the rules quietly changed. The 2026 dividend tax rules may look simple on paper, but their impact is significant. If you rely on dividends to pay yourself, it is now far easier to end up with a higher tax bill, even when your income stays the same. With the allowance cut to just £500, almost every dividend payment is now taxable. At the same time, HMRC is monitoring dividend income more closely than ever, using digital data, platform reporting, and cross-checking systems to identify mistakes. This makes accurate reporting, proper planning, and up-to-date tax strategies essential. Understanding how the rules work, reviewing how you pay yourself, and staying compliant can help you avoid unexpected bills and penalties. Because in the current tax landscape, doing nothing is no longer a safe option. Thanks for watching. If you found this helpful, subscribe for more clear, practical UK tax guidance.